I'm here today with H.M. Rawat, the CEO of Lingo, a new blockchain-based project. So first of all, thanks very much for joining us today.
Hey Glenn, thanks for having me.
I wanted to find out, first of all, well, how you got into this in the first place. What's your background business-wise, and how did you end up in this blockchain-based world?
Yeah, well, I'm based in Mauritius Island, and that was where I was born and raised. We have a family business here. It's a company that partners with around 20 international brands in 10 countries. And I was working with that company for around 5 years as their head of marketing. So got to work with some of the biggest brands in the world, including Nokia, Apple, Oppo, Huawei, Aston Martin, Ferrari, in a few countries, and got to learn how to launch big brands in emerging markets. And after that, I decided to launch my own business. So what I did was Google top franchises in the world, and Subway was number one back then. So I introduced the brand in Mauritius in 2014. We grew that to become the fastest growing quick service restaurant brand in the country before expanding into South Africa, where I was the master franchisee for Mauritius and South Africa too. And I started, after starting South Africa, I started deploying restaurants in Cape Town. And in the Subway system, the way it works is it's the biggest franchise in the world in terms of number of restaurants. They're bigger than McDonald's, bigger than Starbucks. And the way they structure themselves is you have franchisees. There's around 20,000 franchises in the world, but only around 300 to 400 master franchisees or business developers. Some of them are called that term in the system. So the way it used to work is twice a year, all of the 300 master franchisees would meet somewhere around the world, mostly in the United States, and then you'd meet and network with other master franchisees around the globe and share best practices. And we used to hang out with master franchisees from Eastern Europe a lot, from our region. So they merged Africa and Eastern Europe. And in around 2015, 2016, some of the guys from Estonia and Slovenia were very early on in the blockchain space. These countries had a lot of early adopters, especially in Bitcoin. So they were the first ones to talk to me about Bitcoin over there, and how they were trading and investing and how it's going to change the world. And it's basically then that I started dabbling into it, and I started trading as a retail trader and getting to learn more about this industry since around 2016.
So tell us a bit about Lingo then. How did you come up with the idea? Sort of what led towards it?
Right. So I was always a big fan of Steve Jobs. I grew up watching him launch the iPod and then the iPhone, and this guy fascinated me a lot. And one of the best quotes I can remember from him, it's actually from another person. His name slips my mind, but it's referenced by Steve Jobs a lot, especially when he launched the iPod. Is a hockey player saying, what is the exact quote? I skate to where the puck is going to be, not where it has been. And he mentions that this is how Apple has thought about things all along, and they will always do that. And it's something I've tried to apply in my entrepreneurial career all the time. And what was shockingly obvious for me was that most of the Web3 blockchain startups out there were positioning themselves for the existing native market, and we haven't seen many startups position themselves where the puck will be in the next few years. And this for us was key. I mean, as an entrepreneur, the most important aspect, in my opinion, is the market and where the market is going. And this is what motivated me to sell all my restaurants, even though on the South Africa side, it was the biggest entrepreneurial contract I've ever signed. I've ever signed with the biggest franchise company in the world, in the biggest market there. I decided to sell everything, sell all my contracts, and do this full time. Is the market, because today there's around 200 million people in the blockchain space, which is exactly the same as the internet in 1997. But in the 90s, the internet was growing at around 63% per year. Blockchain adoption is growing at 113% per year, which is twice faster. So that makes it the fastest technological adoption in history. So even if you assume that you stop the rate of growth by a factor of 3, we are still reaching 1 billion people in the next 3 to 5 years. And if that happens, it will probably be the most amount of capital ever injected in the history of the world in the shortest period of time. And
so you're investing your own money from the sale of the restaurants then?
yes.
I only ask that because it's kind of reassuring in a way. A lot of blockchain-based projects, obviously, people start with nothing and then they raise investment from other people, and sometimes it feels like they're not putting their money where their mouth is. But you're putting your own money on the line. Your restaurants, as you say, were doing perfectly well, but you decided that to go where the puck is going to be rather than where it is.
Yeah, and on that analogy, where the puck is going to be, we were like, so if there's 1 billion people coming into that industry, these are everyday guys. These aren't crypto natives. And we found that there's 3 big issues today that are blocking the everyday person from entering that space. Number 1, it's extremely hard to understand. Number 2, there's no real life utility. There's no utility in the real world. Like how can I use my Bitcoin or my Ethereum or whatever in real life? And number 3, it's very risky. And we found that most of the startups, whether you're launching NFTs, you're launching a token, you're launching a DeFi protocol, most of the startups weren't addressing these 3 pain points, which is what we were about. So we decided to launch Lingo with the next billion wave coming in, with these 3 aspects in mind. It needs to be easy to understand, it needs to have utility in real life, and it needs to be less risky than what's out there in the market. And to your point, I mean, when I go to a business, for me, it's either a minimum of 7 years full time and doing one thing only. Otherwise, I don't go into any industry. So, which is why I decided to sell everything and go all in. And also, I was later joined by my co-founder. His name is David Amsterdam. He founded a company called John Paul, which became the biggest concierge company in the world. It was later acquired by Accor Hotels for $150 million. And David sold John Paul. He was around 39 at the time. And he was basically semi-retired, and then became an angel investor and invested in a few well-known companies in the European ecosystem. When I approached him with the idea, initially it was for him to invest in the company, but he believed in it so much that he decided to, for the first time since selling John Paul, become a co-founder into this business. So if you go on his LinkedIn right now, this founder of John Paul, and then it's co-founder of Lingo publicly. And that also speaks a lot where, again, he's putting his money where his mouth is, on top of investing, like putting his name on another project after selling his last one for $150 million. So we are all in. If you look at our socials, we've won the 2nd place at the World Blockchain Summit. This is real people. This is me, my face, talking about Lingo. And
that's always an advantage to have an actual real human being instead of an avatar. It's always a bonus in this business.
Oh, absolutely. For us, credibility is everything, and we genuinely think that we're gonna, if the model works, it's gonna have an impact. And for this to happen, we um, we are putting ourselves in a situation where we are maximizing everything that we can for this to impact potentially 1 billion people in the next 5 years.
Okay, so the question is, of course, what is the big idea that attracted your partner David to the business? What is the big idea behind Lingo?
Right. So I explained to you about the three problems: hard to understand, real life utility, and risky. So what Lingo is, it's the first startup that uses blockchain to send people on vacations for free. So essentially, if you think of the existing business model of how do you get free vacations, well, there is the American Express or Marriott model where you can accumulate miles. This is the existing model. So what you can do is you can spend a lot of money using your Amex card, and then you accumulate miles, and then you can claim those miles for free stays, or do the same with like a hotel loyalty program. The problem is that it usually takes tens of thousands of dollars of spending money to end up with one night for free 3 years later. And so we thought the model was archaic, and thanks to blockchain technology, we can now have a way better model by orders of magnitude. So instead of spending a lot of money for a lot of time to end up with peanuts as rewards, the way it works with Lingo is that all you have to do is you have to be an owner of the Lingo token, which is a digital asset that you can always sell back. So it's not like you're burning cash. It's something that you can always sell back. But once you're an owner, what we do is we open a free miles account for you, like a magic miles account. And every single month, your miles account gets rewarded with more and more miles in the form of digital assets. So it's like instead of spending a lot of money to earn a very tiny miles, all you have to do is be a holder of the token. And once you do that, we know that you, Glenn, you're a holder of the token. Every single month, we give you miles for free in your Magic Miles account. And you don't have to spend more money to receive the miles. All you have to do is wait. And every single month, it just goes up and up and up and up. And once you're ready to go on vacation, we've integrated more than 1 million hotels on the platform. So you're not blocked in like you need to go to a Marriott hotel, so you need to go there. There's 1 million plus hotels, and we've done that thanks to our connections with Rachel House, who's the ex-managing director of Booking.com, who's helping us with Lingo. So what happens is you keep on accumulating miles free of charge without doing anything. Once you're ready to go on vacation, you click on redeem, and then you have 1 million hotels, and off you go on vacations for free. And as long as you keep the tokens, even when you're back from your vacations, you keep on accumulating the miles. And that's better by orders of magnitude compared to the existing system today. Where if you don't spend money, you're not getting rewarded. Here, it just keeps going up and up and up and up. And now that makes it easy to understand. It's a token, it's a digital asset that sends you on vacation for free. That's easy to understand. It has utility in real life. You're actually using those assets to go on vacation in real life. And it's less risky compared to other digital assets, because the way we do that, and I'll explain to you how this works, is, and that's why we need blockchain technology, is that we found a way to accumulate real estate assets that are yield generating, and we found a way to tokenize those yields in the form of miles that we give back to the whole community.
Yes, this was something that I found most interesting about the project, because so many blockchain projects that I've looked at in the past, and many which have failed, revolve around, the circular economy, where digital assets are just investing in other digital assets that are investing in other digital assets. And, sooner or later, as we see every few years, of course, there's a kind of crypto goes in cycles, and the whole house of cards can easily collapse. So what I found really interesting about your project is how it's grounded in, as you say, real world assets. It depends upon real estate, which is a far less volatile sector than crypto tokens generally. So it gives it a kind of grounding. Can you explain to us then how the sort of the token circulation works in conjunction with the real estate, sort of, how the real estate gets purchased, how the yields then circulate and become, in a sense, vacations for people, so just explain how the assets circulate around the system.
Sure thing. So real estate, especially rental real estate investments, has been one of the safest investments maybe throughout history. I mean, we've always had to need shelter in human life. You need a place to stay, whether it's a crisis, it's not a crisis, you need some place to stay. So there's always going to be tenants renting out apartments or houses to live. And this is very important for us because, and this might be, and that's why we need blockchain technology, is maybe for the first time in financial history, we've found a way to accumulate real estate assets without needing to raise capital, which means that with the model, you can keep on stacking more and more assets throughout time without needing to raise capital, which means that people joining in the system can expect yields to go up over time because the asset base is going up over time. So the way we do that is that thanks to blockchain, you can code on the smart contract of your digital assets transaction fees. So whenever people buy and sell our token, we code a small transaction fee of 2.5% that goes to buy real estate assets. Think of, if I compare that to Bitcoin, for example, Bitcoin is only as good, and I'm a very firm believer in Bitcoin because of the transparency, the supposed decentralization, and the fact that there's a fixed supply. But the problem is the price of Bitcoin only goes up as long as the other person is willing to pay you for that. So if tomorrow people are completely out, the whole thing crashes. And however, if, for argument's sake, imagine if the founders of Bitcoin coded a 0.1% transaction fee on every buy and sell since day one and invested that into real estate. Number one, this would have no change, no substantial change in trading volumes since day one because it's only 0.1%. But number two, you would have $50 billion of real estate today that would generate yield, that would support the token, and that would generate yield for the whole community. $50 billion since day one. And that would make Bitcoin exponentially more solid today. Because there would be these assets that would keep on backing it, and then every single year those assets would keep going up and up and up and up because people would keep on trading. So you keep on accumulating more and more real estate that would generate yield. So the way it works for us is whenever people buy and sell the token on the open market, we charge a small transaction fee. This gets invested in real estate assets, real hard assets, and now these assets generate rent every single month in real money, in fiat. And this is where the magic happens. What we do is we take 100% of the rentals. We don't take 0.1% and give you cashbacks like the typical names I mentioned for miles. We don't take 0.1%. We don't take 50% like most of the Web3 ecosystems and give 50% to the community and keep 50% for the owners. We have a fully community-centric model where we use 100% of the net yields generated every single month. And then what we do with those is we buy back our own token on the exchange, on the open market. Now we have a fixed supply of tokens. So by doing this, automatically you're adding buying pressure on your token over time. And it's every single month. So coming to the risk aspect, somebody's like, okay, well, crypto is risky, right? Well, this one, in Lingo, they know that every single month there's real money with real rents that are used to buy back the token. So this already makes it a less risky option and already makes it more likely to gain value over time. But this is not the purpose of Lingo. The purpose of Lingo is to send people on vacations. So what we do is we buy back tokens every single month, and then we airdrop those tokens. And again, that can only be done thanks to blockchain. We airdrop those tokens immediately to every single holder in their free miles account. So the miles that you are accumulating actually comes from rentals generated every single month. Now, this in itself is already orders of magnitude more interesting than the typical mile system because it's not a cashback. It's every single month that we're using 100%, not 0.1%, and give everything back to the whole community. And that's how you accumulate your miles. But, and this is a big but, and this is the real revolutionary part about it. Imagine if next year, the market cap of the token stays the same. We're not even saying, look, we're going to do 1000x, even though it's possible. Let's just say we do 0x in terms of growth. It's still the same. So we have the same market cap year 2. We have the same daily trading volume year 2, which means that with the same transaction fees, we've doubled the asset base year 2, which means that your yield has now doubled, assuming you're doing the same yield. Which means that the miles that you're receiving year 2 technically now is double what you're receiving in year 1. And if the same thing happens in year 3, then you're tripling it. The same thing happens in year 4, then you're quadrupling it. So it's a way where you've invested once in Lingo, and then in theory, if the market cap stays the same and the trading volume stays the same, your miles in year 2 gets more, and your miles in year 3 gets more, and your miles in year 4 gets more. And for the end user, it's like, all I have to do is getting Lingo once. And by the way, it's a less risky option. So this in itself makes it worthwhile. But then again, I know that I'm going to go on vacation every year. As long as I'm keeping my tokens, every year I'm going on vacation. And that's a deep, I wouldn't say problem, that's a deep a value add in someone's life, because the modus operandi for most people is you go to school, you go to college, and then you work 50 years at a job that you hate so that you can go on vacation once a year. What if you've made the right choice with Lingo and we can take care of the vacation side for you? How better would your life be? Because you know that whatever happens, once a year, at least you're going on vacations.
I know it's at a very early stage still, but have you been able so far to be able to put together any estimates of, say, how much somebody would need to invest in Lingo tokens in order to get a certain kind of holiday after a certain amount of time? Is there any estimate along those lines, or is it too early for that still?
We have various models. Obviously, there's many variables in terms of the market, in terms of the private sale and everything. But from our estimates, based on conservative estimates, we should be able to generate around a 12 to 15% return in the form of miles on year 1. And obviously, depending on what happens on year 2 and year 3 and year 4, this only goes up because you're adding to the real estate assets.
I see. So yeah, the assets are growing. So in terms of the tokenomics, as you said, you're buying back tokens each month using part of the rental yield in order to buy back tokens, in order to shrink the supply of tokens. At the same time, obviously, tokens are going to be released on a schedule, I guess, over the next few years. So when does the supply sort of reach its peak?
Right. On the vesting schedule, it reaches its peak, and you'll see it's a very healthy release schedule of around 5 years. We've had our tokenomics challenged by brightnode.io. It's a company that's based in Switzerland with as institutional bankers. We've had it challenged by another company called Crypto for All, based in Paris. They've been in crypto since 2013. And we've had it especially challenged by our CTO, who's the ex-head of engineering at Consensus. And for people who don't know what Consensus is, it's one of the most well-respected companies in that space. It was co-founded by the co-founder of Ethereum. And so you'll see that the release schedule is quite healthy and takes 5 years. You won't see a massive peak in where all the tokens can get dumped. But back to your point of real assets, what we realize is that the Luna example, like the Luna crash, would not have been possible for us, because what Luna taught us is you can create value out of thin air. It's well and good to be able to generate yields, but what's the purpose of getting a 20% APY if the whole thing is backed by nothing and you can the next day crash?
Yeah, that's
So
kind of what I
that's
was thinking of when I said earlier about the circular economy that a lot of cryptos have, the so-called Ponzi-nomics of the whole thing. Whereas, a lot of the best projects focus, or at least try to put their feet on the ground to some degree. That's why I found it so interesting that you're using real estate in this way. And of course, as you pointed out, the way that the assets actually build over time, if you have a constant stream of transaction fees over a number of years, then those transaction fees are constantly invested in more real estate and more real estate, so that over time, I guess the quality of holidays and the expense of the holidays or the vacations that are given to people grow and grow over time, even for the same quantity of tokens owned. Is that correct?
absolutely, that's 100% correct. And more than that, even if you look at the FTX example, like what FTX taught us is you can be over leveraged, and models where you custody people's own money is extremely dangerous. It needs a lot of policing. So our model works without us having to custody people's tokens. I mean, they can custody their tokens on a hard wallet themselves. This is not our business. And also, we are under leveraged. So on the real estate side, we take a 50% debt to equity ratio, and we only buy existing profitable real estate assets. So worst case scenario, there's a 2008 crash in the real estate market. We buy rental properties. We're under leveraged. People still are paying rentals. We're still generating cash flow. So tomorrow there's a big crash in the crypto space. It happens every 4 years. There's a massive crash. Well, fair enough. The real estate is still generating rentals every single month. We're also using those rentals to buy back our tokens, which makes the liquidity injection into the token quite healthy, whether it's a bull market, whether it's a bear market.
So you won't be taking out loans then to buy the rental properties. You'll be buying them with actual money from the transaction fees rather than borrowing most of it.
Well, it's always healthy to add some debt in real estate as long as it's conservative. So we take a 50% approach, it's 50-50. So if we've generated $20 million in transaction fees in 1 year to buy real estate, we would take the equivalent in debt, which in real estate terms, especially for rental real estate, is quite conservative.
It is conservative, yeah. So in other words, the the value of the properties would have to fall by 50% in order for the investment to start going underwater, which is obviously a 50% drop in real estate in most parts of the world anyway is pretty rare. It's very rare. So yeah, I see. So you've taken a conservative approach to the borrowing, which sounds sensible. It means that you can see a big drop in real estate prices and still be okay.
Yeah, I mean, this space is risky enough, and to be honest, what interests most people in that space is the risk reward, right? So most people invest in crypto today, especially the native market, to speculate. They want to make 100x, but they are very willing to do zero because this is the name of the game. So what's happening with Lingo is you can still make whatever x in terms of upside. You can still go 100x because we don't peg the value of the token to the real estate. It's still a digital asset. People can speculate. They can know that, look, in 10 years, if it goes well, they're going to buy all of these real estate. This is going to attract a lot of people. And it's a virtuous circle where the more people go on vacations, the more the coin trades, because with word of mouth, people talk about it. So the more we send people on vacations, the more it attracts a bigger community. The more it attracts a bigger community, the more real estate we buy, which means that the more we send people on vacation, which means that the community grows, which means that we buy more real estate. And so it's a virtuous circle of value creation in the whole system. And so that leaves the door open to lots of speculation for the price to do 100x. But they know that worst case, if it's a bear market, there's still real estate supporting the token. So it's compared to most of the other tokens, are you as likely to do 100x? Yes. Are you less likely to do zero? Absolutely, because there's real assets behind. So the risk reward in itself is way more interesting.
Yeah, that is very unusual in the token space, that you've actually sort of artificially created almost a floor on the price. Not, not necessarily a definite floor, because obviously it depends on the value of real estate. It depends on the amount of transaction fees you're getting in any one year. But nonetheless, there's a basis for valuation there, which in itself is pretty unusual in the world of crypto, which is why, of course, the prices often rise hundreds of percent and then fall by 95%, because even with some of the biggest ones like Ethereum, it's impossible to know how to value them if they don't have revenues and profits. But by tying your token to some degree, but as you say, not entirely, the value of the token doesn't depend on real estate prices, but it at least sort of reflects them to some degree, and it provides something of a floor to the price for the tokens, or potentially a floor. I find that side of it pretty interesting. That's different from most projects that I've looked at.
And that ties into the three issues for the mass market. So the number three is, yeah, I want something that's easy to understand. If I understand it and I can use it in real life, in a way that adds value to my life, well and good. Normally, the third thing is, well, this is crypto, so it's risky, so maybe not. Well, this solves the risky aspect.
Yeah, it definitely helps with that, doesn't it? It helps to improve the sort of risk profile of the whole thing a lot, by the sounds of things to me. Though, of course, people still need to be aware that, this is a startup venture, and therefore, it involves risk. But yeah, compared to a lot of projects I've seen, I am somewhat reassured by the real estate element to it, and the way that it would has implications, as I say, for a possible sort of notional floor for the price of the token. Looking ahead, I'm interested to kind of work out in the future. I mean, we've talked about how over the next sort of couple of years, we'll start to see the value of the real estate increase as transaction fees create more and more money that you can invest in real estate, and then you get the yields off that real estate, which are then used for the vacations. I suppose if you were to look out 5 years from now, say I was this is terrible that I'm getting you to try and guess this. You don't have to put a figure on it if you don't want to, but let's say I'm a small investor who has put $1,000 into your tokens. Are you able to kind of do a brave guess about, in 5 years' time, what kind of vacation allowance would that $1,000 get me in 5 years' time?
Well, that's a good question. It all depends on what kind of market cap you can sustain and what kind of trading volume you can sustain over those years. And this is crypto, so we can be surprised. You can have a weak market cap, but in general, we haven't seen market caps go in the weak zone, which is what we consider a weak zone, with that amount of marketing firepower that we've managed to amass. So what I haven't told you yet is that thanks to the fact that it's a safer option, it's a less risky option, that it has utility in real life, and it's simple to understand. Our model has excited and engaged a lot of celebrity interest and crypto expert interest, and since more than a year and a half now, we've managed to sign contracts with over 100 celebrities, athletes, international DJs, actors, and crypto experts, combining more than 300 million followers. And the craziest part is we have a commitment of anywhere from 48 to 100 social media posts per celebrity in 5-year contracts. And that is unseen in the industry. The closest that we've found to that is an NFT project called the Bored Ape Yacht Club, where they had around 70 celebrities change their profile picture to apes last year. They then launched a token called ApeCoin, which launched at around $3 billion in valuation. And now with the bear market, they're around 1.5 billion. We're not talking about 70 celebrities, we're talking about 100 plus. If you look at the French national team who are at the finals, we have half of the French team who signed with us, for example. And so we're talking about more than 100 celebrities and crypto experts. We had an event in Miami a month and a half ago And there was BitBoy Crypto over there at our private event, Crypto Wendio, who has the largest female audience. We had dinner with the Altcoin Daily Brothers, who have probably the second or the number one biggest channels on Twitter and YouTube in the crypto space. So we're talking about crypto experts and big time celebrities. But we're not talking about one profile picture. We're talking about 48 to 100 social media posts, which is unseen. So we haven't seen projects with that kind of marketing firepower. That represents around $50 million worth of marketing contracts that we've secured. And we haven't seen digital assets launching with that amount of firepower with weak market caps. So even if with all of this marketing firepower, let's say we are off by 1/15th of what ApeCoin did, even though there's a lot more marketing firepower, we have a model that has utility in real life, that appeals to people with the free vacations, that's less risky, and we have all of this marketing firepower. Let's say we miss the mark by 1/15th. Instead of doing 1.5 billion in market cap, we only do 100 million in market cap. With normal trading volumes, we should be able to generate around $10 million a year in real estate. So in 5 years, to answer your question, that's $50 million a year of real estate after 5 years. Assuming you're doing a 6% yield, if you invest $1,000 year one, you should be able to generate around a 30% return year five. And again, you haven't done anything. You've just chilled for 5 years and enjoyed your vacations along the way.
I can see why the marketing is so important, and it's interesting that you've signed people up for 5 years. Did you say are they tied into 5-year contracts, or is it
Yeah.
sort of more?
Yeah, it's signed contracts.
Oh, well, that's very interesting, because obviously the transaction fees are so absolutely key to raising money for the real estate in your project. So having that kind of marketing firepower on an ongoing basis is key. So it's I like the fact that you thought of that in advance and signed people up for longer term contracts, because the transaction fees need to be ongoing in order to get the whole real estate asset thing underway and to keep it growing and growing. Yes, that's an interesting one. So where do you see this project in 5 years' time? In your sort of wildest imaginings, what do you see happening in 5 years?
What we need is, if we're able to sustain a relatively healthy market cap with a relatively healthy trading volume per day, which is not hard to do, especially with the team that we have. If we manage to execute on that properly, this would catch in a way where, as I told you, it creates this upward circle of value creation. So we're sending people on vacation, word of mouth, people getting excited. It's attracting a bigger community, which makes us buy more real estate, which makes us send more people on vacation, which attracts more people. And if that takes off with the right execution, what would in theory happen is a flywheel that goes faster and faster and faster. So we would have essentially,
until you own all the real estate in the world.
This would be an empire of real estate that just keeps getting bigger and bigger and bigger, for one purpose only: sending people on vacation. And for us, this is and thanks to that technology, this can now be a reality. This is the whole purpose of Web3 in that space. It's transparency, it's value for everybody. People are calling it the biggest potentially the biggest redistribution of wealth in history in the shortest period of time.
I'm gonna just go into the mechanics of it a little bit, just to work out with the transaction fees. As you say, if Bitcoin were to have sort of instituted a similar system, then many, many billions or tens of billions even would have been raised in that time. A lot of crypto projects use transaction fees for all kinds of different things, to secure the network, liquidity providers, that kind of thing. So I guess my question would be, if so much of the transaction fee is going into buying real estate, is there, the places that it's not going as a result? How do you sort of compensate the actors who keep the whole system going, like liquidity providers and so on, if there's no transaction fee incentive for them, or is there still a transaction fee incentive?
That's a very good question. So out of the 2.5% transaction fee that is coded on the smart contract, 17% is used to buy real estate. And the rest goes to a mix of working capital and also ongoing marketing going forward, because you have to stay top of mind. And this is also something we haven't seen in utility token projects. We've seen that maybe with crypto.com, where they try and stay top of mind, or Binance. But as a utility token protocol, we haven't seen people focused on branding, and that takes a lot of time. So which is why part of the transaction fees, around 10%, goes to marketing and branding over time, to make sure that you always stay top of mind and you're always growing your brand equity. But 20% goes to the working capital, to pay for the employees, to address the technical innovations, etc., etc.
Right, got it. I see. So it's a split. There's a mixture that way. Interesting. Is there, I think we've covered pretty much everything about this project that I wanted to cover. Is there anything else that you wanted to discuss?
Yeah, sure. Well, we mentioned the risk element there, and it is a startup and it is private equity. We've managed to raise around $3 million in seed already. And what our investors have told us is that they typically invest in private equity because you want to make a 20x on your investment, and you're willing to do 0 on 19 investments out of 20. So essentially, if you're lucky with one company out of 20, you're breaking even, and if you're lucky with 2 companies, then you're making 20x on your investment. That's the thesis for most private equity investments. Now, Web3 private equity goes a step further, where you're expecting to do 50 or 100 instead of 20, but you're much more likely and aware that this can go to 0. The fact that there is a real estate element in what we're doing, the fact that before launching the token, we are already buying real estate. So we're not waiting for transaction fees to buy real estate. We are buying real estate today before launching the token, so that on day 1, we can always already send people on vacation. This allowed us to protect the investment of our investors by 50%, because what we do is we invest half of the money in real estate anyway. So what the feedback that we've had with our investors is that what's interesting with Lingo, is that they are still getting the upside of Web3 private equity. So we are forecasting to do, again, this model does not exist. So there's not a real systematic way to correctly quantify the odds of success. But we think that the upside potential is going to range from a 3x to a 200x if it works. Now, it is still private equity. There is still a risk, but worst case scenario, the downside can only be 50%. And that's on shareholder agreements. So this is what attracted our investors, saying that you can make a 200x, but worst case, I can only make minus 50%. And that, in private equity in general, they haven't seen that. So the risk reward was quite interesting for them.
Yeah, I like the analogies that you've made, because when I do speeches about investing in crypto and that kind of thing to a general investment audience, I try to get them to understand that it's kind of like, well, what we have in Britain, Dragon's Den. I think in America it's Shark Tank, isn't it? But the point is that, traditionally when people are investing in stock markets, it's a bit of a different thing because of the revenues and the profits, and the fact usually that, of course, IPOs come to stock markets quite late on in the maturity of the firm. Whereas obviously with crypto, it's something we've never seen in the history of the world before, where ordinary people are able to get in on the ground floor of new projects. And so, people were getting in initially going, oh, I'm going to make tons on this. I'm going to make tons on this one and this one, and, buying up loads of them. But what they didn't realize is that it's like Dragon's Den. It's like completely new startup projects, a few of which will do incredibly well, and many of which will not do well at all, and their tokens will go way down. So I always try and warn people of that, that it's, you know, that's the kind of thing. It's like you're a venture capitalist, but you're just an ordinary person. But when you invest in crypto, it's kind of like you need to be in venture capitalist or dragon kind of mindset. With that in mind, how can people invest in the tokens? How do they go about it?
Well, right now we are closing the private round. So we are only onboarding small investors. And the reason why we're doing this is that the fact that no one's done that before, the smaller, most influential people that we have, the higher the chance that the token explodes to 200x in 3 years. So we are only letting in smart money. There's two ways to get in. It's either on the token only basis, so you are investing in the token before the public sale at half price of the public sale, and that's a minimum ticket of $50,000. And this is where we've raised most of the investments with our investors. It's a ticket of $500,000. Which gives you the token and exposure on the equity side too. And as you guessed it, not only on the value of the business, which is a tech company that can do X in the future, but all the real estate that we accumulate is on the balance sheet of that company. So that gives you exposure to equity and tokens, and especially the 50% floor if ever things go south. Our process to onboard new small investors, there's normally a discovery call that we do. So this is available on our website called mylingo.io, mylingo.io, and you'll see you can apply to become an early investor. There's a bunch of questions, and then you can book a discovery call, and then if things go well, we can discuss. So that's on this is only reserved for private investors now. The next step for us is to launch an IEO with a tier 1 exchange. I can't name names now, but we're in advanced discussions to do an initial exchange offering with a tier 1 exchange. And then people will be able to either buy tokens on the exchange or on our platform directly. And they can still register in the waiting list on our website.
Got it. And actually, one other thing that I didn't think to ask before, but it's just popped in my mind, is when you're buying the real estate, have you got specific geographical areas in mind, or are you just buying a swathe across the whole world?
That's a very good question. One of our board members runs a fund called Absolute Capital, where they already invest in rental assets, mostly in Europe. So they already have a pipe. That's their job. That's their expertise. So the initial real estate that we're buying will be in Europe. Now going forward, we will let the community vote to where we buy. So let's say in 3 years down the line, we find that most of the Lingo community members are Vietnamese, or you name it, or from Nigeria, for example. It doesn't change much to the model, to where we buy real estate, as long as the yield is relatively healthy. We're targeting a 4 to 6% yield on the real estate assets, only profitable assets. So what we'll do in our process is just mandate a company or a fund that usually does that. They have teams of due diligence, analyst teams. They are normally listed companies. We'll tell them, look, this year we've managed to gather $40 million that we need to buy real estate. Shortlist the best opportunities you can find with these and these criteria, and then essentially we'll give that shortlist to the community, and they will vote to where they want to buy it. It doesn't change much to the model, but it's always cool to have a say in where we buy. So if most of the community is Vietnamese, they say, oh, we have something great opportunity nearby, let's buy that, and that boosts engagement.
Excellent. Well, that's pretty much all my questions. I really appreciate your time. Thanks very much for joining us here today, HM, and for answering all my questions. I look forward to seeing how the project does in the years ahead.
Thank you, Glenn. Thanks for your time.